Right now, something is building in the commercial real estate market that most people have never seen before. A $930 billion wall of debt. Loans taken out when interest rates were at historic lows. Loans that banks and borrowers have been quietly kicking down the road for 3 years now, hoping, praying that rates would fall and bail them out. They didn't. And here's the part nobody is talking about on the evening news. The last time something like this happened, the last time a massive wave of commercial real estate distress hit the market, regular people who understood the pattern and had a plan walked away with life-changing wealth. Teachers, dentists, small business owners, people who were not on Wall Street, people who just recognized the setup. By the end of this video, you are going to understand exactly what is happening, why it matters, what history says comes next, and what options exist for people who are paying attention right now. Stay until the end. This one is different. To understand why this matters, you have to start at the beginning. Because if you don't understand the problem, you cannot understand the opportunity. According to the Mortgage Bankers Association's 2024 Commercial Real Estate Survey of Loan Maturity Volumes, roughly 20%, or $929 billion, of the $4.8 trillion in outstanding commercial mortgages held by lenders and investors matured in 2024, with $957 billion set to mature in 2025, a 3% increase. To put that in plain English, nearly $1 trillion worth of commercial real estate loans, office buildings, apartment complexes, retail centers, hotels are coming due right now. The landlords and property owners who took out those loans have to either pay them off in full or refinance them at today's interest rates. Here's where it gets complicated. A surge of these loans were originated during an ultra-low rate era. Borrowers who locked in financing at 3% to 4% in the mid-2000s are now facing refinance rates that can be nearly double or more. And it gets worse. Over $1.5 trillion in commercial real estate loans reached or will reach maturity across 2025 and 2026 combined, with this year alone accounting for more than $930 billion in scheduled maturities. That number, $930 billion, is not an accident. It did not get that big overnight. It got that big because of a very deliberate strategy that banks and borrowers have been running for the last 3 years. A strategy that Wall Street insiders know by a very descriptive name. They call it extend and pretend. And to understand what that phrase actually means, here is how it works in plain language. A commercial property owner has a loan coming due. The property is worth less than it was when they borrowed. Refinancing at today's rates would be brutal, or outright impossible. So rather than force the borrower to default, the bank quietly extends the loan's maturity date by 1 or 2 years, and both parties agree to pretend everything is fine. The challenge has been compounded by extend and pretend strategies that dominated 2023 and 2024. Rather than force defaults during a period of extreme valuation uncertainty, many lenders opted to modify or extend loan terms, pushing maturities into 2025 and 2026. The scale of this is staggering. Lenders extended a record $384 billion in commercial real estate loans into 2025. According to a Colliers report, $384 billion of loans originally set to mature before 2025 have been pushed into this year, a 42% jump from 2024's total of $270 billion. Think about that. $384 billion in problem loans that were supposed to be resolved years ago, just pushed forward. Added to all the new maturities already scheduled, the result is a compressed timeline where an estimated $400 billion in previously extended loans were added to scheduled maturities, creating what analysts now describe as a maturity tsunami rather than a wall. But here is the critical piece. The New York Federal Reserve Bank has weighed in on this directly. A bank analysis titled "Extend and Pretend in the U.S. CRE Market" describes a situation where banks fueled loan maturity extensions, giving rise to a wave of debt coming due soon that it states likely won't be paid. The New York Fed report concluded that extend and pretend behavior has led to an ever-expanding maturity wall of commercial real estate loans, which it argued represents a meaningful financial stability risk. Bank's own internal mantra for the last 2 years? Survive until 2025. The theory was that rates would drop precipitously and basically bail out many banks' portfolios. Unfortunately, the wait until 25 mantra is not going exactly as planned. Inflation has continued to stay well above the Federal Reserve target of 2%, along with huge deficit spending, leaving long-term rates considerably higher than predicted. The pace and quantity of interest rate reductions has radically changed, with many predicting that interest rates are ultimately going to settle considerably higher than anticipated. The game of extend and pretend is running out of runway, and the debt does not disappear just because you push it forward. In Q3 2025 alone, tens of billions of CRE loans were adjusted to delay defaults and avoid fire sales. But this only kicks the can. The debt and higher rates remain, and many extended loans are now crowding into the 2026 window. And that pressure is no longer theoretical. It is now showing up in the hard numbers. In the first quarter of 2025, the total volume of distressed assets reached $116 billion, a 31% increase from a year earlier. Total distressed commercial real estate volume reached $126.6 billion in Q3 2025, an 18% increase year over year. And the office sector is ground zero. Office continues to face the greatest difficulty. Vacancy rates remain near 19%, and demand for traditional space has not returned to pre-pandemic levels. Among office loans that matured before 2026 and still have balances outstanding, 83.7% show delinquencies and 92.7% require special servicing due to loan repayment or payoff problems, according to CMBS loan data. The dominoes are lined up, and they are starting to fall. And if you want proof that this is not theoretical, that it is not some future event people are speculating about, look at what is already happening to specific buildings in major cities. The AT&T Tower in St. Louis was bought in 2006 for $205 million. It sold in 2022 for $4 million. The Hughes Building in San Francisco was bought for $62 million in 2016 and sold in April 2024 for $6.5 million, a nearly 90% haircut. Market Street Towers in San Francisco sold for $177 million, 76% less than their 2019 price. Downtown Denver Towers traded at $5.3 million, down from $176 million in 2013. These are not minor corrections. These are once-in-a-generation price resets. And here is the thing about price resets. They create buying opportunities. Sales of office buildings in San Francisco could top $1 billion in 2025, according to CBRE. There are about 30 buildings currently under contract or being marketed for sale, and if those sell, about 9% of the city's 100 million square feet of office inventory would have been sold at a substantial discount from previous acquisition prices since 2023. The reset in prices could allow new landlords the opportunity to lower rents, which could spur leasing activity and invest capital into improvements. If leasing trends further improve, interest rates decline, and the economy accelerates, recent investors could be rewarded with much higher building values in the years ahead. Notice who is moving into these markets now. Institutional investors have re-entered the San Francisco market after being absent in 2023, when only all-cash and high-net-worth buyers were in the market, according to CBRE. Smart money is moving. The question is whether regular people will recognize the pattern in time. And to answer that question, you have to look at history, because this is not the first time this has happened. This exact playbook has run before, and the people who understood it and acted on it changed their financial lives permanently. In the late 1980s and early 1990s, the savings and loan crisis triggered a commercial real estate collapse that makes today's problems look modest in some respects. Banks failed by the hundreds. The Resolution Trust Corporation, a government agency set up specifically to liquidate failed banks' assets, was selling commercial properties for 20, 30, even 50 cents on the dollar. Texas real estate in 1990 was essentially free if you had cash and patience. Office buildings in Dallas, strip malls in Houston, apartment complexes in San Antonio. People who bought during that period of maximum fear and distress and held for the decade that followed made extraordinary returns. That is a documented historical fact. Then came 2008. The International Monetary Fund estimated that large U.S. and European banks lost more than $1 trillion on toxic assets and from bad loans from January 2007 to September 2009. The U.S. entered a deep recession, with nearly 9 million jobs lost during 2008 and 2009, roughly 6% of the workforce. Commercial real estate got obliterated. Properties that had been valued at $50 million were trading for $10 million. Loan packages that represented entire portfolios of distressed real estate were being auctioned off for fractions of face value. The people who walked into that chaos, who had patience, dry powder, and an understanding of historical cycles, built generational wealth. In October 2008, Warren Buffett published an article in the New York Times op-ed section declaring he was buying American stocks during the equity downfall brought on by the credit crisis. His version of buying when there is blood in the streets. Be fearful when others are greedy, and be greedy when others are fearful. But this was not just billionaires. Everyday investors, people with some savings, discipline, and the ability to control their fear, who put money into real estate investment trusts at the bottom in 2009, or who bought distressed properties in beaten-down markets, rode one of the greatest recoveries in modern real estate history. In the past 50 years, real estate returns have exceeded stock returns with significantly less volatility. In fact, since the early 1970s, real estate has beaten the stock market nearly 2-to-1. The pattern is always the same. Panic, distress, fire sales. Then slowly, then quickly, recovery. New highs. And the people who had the courage and preparation to buy during the fear, those are the ones who look back on that moment and call it the single best financial decision of their lives. According to the Wall Street Journal, a growing number of property investors are already preparing for what they believe could be a once-in-a-lifetime opportunity to buy commercial real estate assets at bargain prices. That sentence, read it again. A once-in-a-lifetime opportunity. The Wall Street Journal, not a YouTube channel, not a Reddit forum, the Wall Street Journal. Now, here is what separates this cycle from the ones that came before it and why it matters. In past cycles, distress was typically concentrated in one asset class or one region. The S&L crisis was heavily concentrated in Texas and the Southeast. The 2008 crisis was concentrated in residential mortgages and the financial products tied to them. What we are dealing with now is different in both scale and breadth. Approximately $950 billion of CRE mortgages matured in 2024, and the maturity wall is expected to peak in 2027 at $1.26 trillion. In 2025 alone, nearly $1.0 trillion in CRE loans matured, and by the end of 2026, well over $1.5 trillion will have reached maturity. Some estimates put 2026 maturities as high as $1.8 trillion, marking one of the largest refinancing waves in history. The stress is spreading beyond just offices. Multifamily alone accounted for $22.8 billion of distressed commercial volume in Q3 2025, representing 18% of the total, and marking a significant increase from historical norms when multifamily was considered among the most stable asset classes. After reaching approximately $104.1 billion in 2025, multifamily loan maturity jumps 56% to roughly $162.1 billion in 2026 and edges higher to $167.7 billion in 2027, creating a two-year peak that will test refinancing capacity and pricing. And critically, smaller regional and community banks are the ones most exposed. A sobering analysis from Newmark Group saw dangers in CRE lending with an overconcentration among small and regional banks, which tend to hold more CRE loans and are often less well capitalized than the larger money center banks. According to first quarter 2024 regulatory data, 67 banks had exposure to commercial real estate greater than 300% of their total equity, with 60 of them at heightened risk levels. This is a lot of stress, concentrated in a lot of places, hitting all at once. And that, paradoxically, is exactly why it creates opportunity for people who are positioned properly. Which brings us to the real question, the one you actually came here for. When billions of dollars worth of commercial real estate hits the distressed market, who gets to buy it? And is there a way for a regular person to participate? The answer is yes. But you need to understand your options. REIT is a publicly traded company that owns commercial real estate. When CRE values collapse, REIT share prices often get crushed, far beyond what the underlying assets actually justify, because fear drives indiscriminate selling. During the 2008 to 2009 crisis, many high-quality REITs dropped 60%, 70%, even 80% in share price. The people who bought those shares at the depths of the panic and held them through the recovery made extraordinary returns, without ever having to manage a single property, deal with a single tenant, or understand the intricacies of a commercial loan. After a rocky 2025, REITs are poised for a strong 2026 as public-private valuation gaps close, international diversification pays off, and institutional capital ramps up. You can buy REITs through any brokerage account, the same way you buy a stock. Over the last decade, a new category of investment platform has emerged that allows non-institutional investors to pool capital and invest in specific commercial properties. When distressed assets hit the market at steep discounts, some of these platforms actively seek them out. This gives individual investors access to a type of deal that was previously available only to hedge funds and private equity. These come with real risks. Liquidity is limited. Not every deal works out, but for investors with a higher risk tolerance and a long time horizon, distressed CRE crowdfunding can offer very attractive potential returns. For investors who want exposure to the resolution of the CRE crisis without buying equity in specific properties, mortgage REITs and funds that invest in commercial mortgage-backed securities offer another avenue. When loans default, restructure, or resolve, these instruments can generate meaningful returns for patient investors. But whatever path you choose, the rules are simple and non-negotiable. Rule 1. Only invest money you can afford to lock up for at least 5 years. Distress cycles take time to resolve. The people who panic sold their REITs in March 2009 locked in massive losses right before the recovery. The ones who held or added during the fear? They retired early. Rule 2. Diversify. Nobody, not the best analysts on Wall Street, can predict which individual properties or loans will resolve favorably. Spread your exposure across multiple assets, sectors, or geographies. Rule 3. Know your risk tolerance honestly. This is not a savings account. Prices can fall further before they rise. Loans can default. Properties can deteriorate. You must be emotionally and financially prepared to weather volatility. It is critical to understand that during a time of market distress, when conditions may be anything but normal, individual investors can still find opportunities in new asset classes and build wealth. And here is what separates this moment from pure doom and gloom. The early signals of recovery are already appearing. In San Francisco's office market, CBRE's Kyle Kovacs said, "In my opinion, 2025 will be looked back upon as the most important year in San Francisco's office market recovery, marking the return of institutional investors and owner-users, tenant demand reaching pre-pandemic levels. Office values remain approximately 15% below their 2022 peak, but rose 5.38% year-over-year, outpacing the broader CRE market's 2.8% gain. Return to office mandates, renewed leasing, and 2 Fed rate cuts lowering the funds rate to 3.75% to 4% are helping support valuations. Urban core office prices rose 5.1% year-over-year, the first time since early 2022 that CBD values led the pack. This backdrop sets the stage for more motivated sellers. As more distressed or near-distressed assets come to market, pricing power tilts toward buyers. Periods of financial strain for some can create attractive opportunities for others, and the 2026 maturity hump is no exception. The pattern is rhyming. The fear is real. The discounts are documented. The smart money has already started moving. The question, as always, is whether you will be too early and look smart or too late and wish you had acted. So here is the bottom line. A $930 billion maturity wall, combined with 3 years of extend and pretend exhaustion, is forcing a reckoning in commercial real estate right now. The maturity wall of commercial loans is real and will eventually have to be reckoned with. Commercial values have plummeted. Interest rates have remained much higher than the markets anticipated. These factors are a deadly cocktail for a pending correction in commercial real estate. But the last time a crisis of this magnitude hit commercial real estate, in the early 1990s and again in 2008 to 2009, the people who studied the pattern, controlled their fear, and acted when everyone else was frozen, walked away with life-changing outcomes. Not billionaires, not hedge fund managers, regular people who understood one simple truth: markets create the biggest opportunities at the moment of maximum fear. The S&L crisis created millionaires out of ordinary Texas buyers. The 2008 crash created millionaires out of investors who bought beaten-down REITs and held them. This cycle, the single largest commercial real estate maturity event in modern history, is creating the same setup. right now, in slow motion, in front of everyone who is paying attention. You don't have to be rich to start. You don't need a finance degree. You need a plan, patience, and the discipline to act when your gut is screaming at you to run the other way. History doesn't repeat exactly, but it sure does rhyme. If this video changed how you think about what's happening in the market right now, subscribe, drop a comment below with your biggest takeaway, and share this with someone who needs to understand what is coming. And remember, this is for educational purposes only. I am not a financial advisor. Talk to a licensed professional before making any investment decisions. See you in the next one.